Hello, my name is Cassandra. Today I am going to go through the accounting cycle project part 1 and describe the journal entries, why I made certain calculations, purpose of adjusting entries, financial statements, closing entries, and then the post-closing trial balance. As you can see here, the first entry that was put in for October 1st was the beginning of the company. The person, S. Ray, invested $54,000 in cash, $29,000 in computer systems, $9,000 in office equipment. So those are all debits here on the left-hand side. And then I found the $92,000 out by adding those three things together because my debits have to equal my credits. Journal entries are, the first step in an accounting cycle, and they record all of the business transactions. So especially that first one is so important because if you're not getting that first one in right, everything from there is going to be off because I can't debit from my I can't take from my cash if there is no money in it. So by putting in the cash originally, we're able to make that prepaid rent and then go from there in terms of other things that are necessary. As you can see, there's quite a lot of things that we use cash for. Occasionally, there are things that we don't receive cash for right away, and those go into, like for revenue, those go into accounts receivable, and then later, once the accounts receivable is paid out, it goes into the cash and then it's removed from the accounts receivable. But yes, there is a lot of cash that is used. So especially having that original revenue in is super important here. And then once we go from journal entries, it's important that we are using our ledger balance accounts. They are a great way to see the debits and credits that you've used throughout the cycle to make sure that your ending balances are correct. And these can help you, especially when it comes to preparing your financial statements. It's just a great way to be able to see your trial balances added in here. And then we'll go to question 2 and kind of discuss that a little bit. So this was kind of the same thing here. There was a list of things that had happened. These are more so for adjustments. So this is, the end of the month. We're closing out we're adjusting things for the accounts for things that have happened. So, December 31st, we, let's go to this one. December 31st, we figured out that there was $590 left of computer supplies. So if we took our original computer supplies balance, which was $2,645, and then we add in the computer supplies that were bought on December 15th for $1,500, and then we subtract that by $500 or $590. That's what gets us to our $355 or $3,555 for what we're taking away from computer supplies in a credit here, and then we're also debiting it on this side because now it's an expense. Expenses are debited. By entering all of the adjustments, it's actually showing the true balance of the accounts. So that's why it's so important to do these during the end of the period for whatever the accounting cycle timeframe is that they do reports for. I know typically it's like the end of the month, but occasionally it's quarterly. Just really depends. But by being able to take, the total amount of computer supplies and subtracting it by $590, which is the remainder, means that we had to take $3,555 away. And then for the 3 months of insurance have expired since the 12-month premium. So we paid the total balance of insurance for $2,040 3 months ago. So if we take 3 months from that, it's going to be $510. And then we always debit to expenses. For a adjustment, the expenses are always going to be in a debit. And then so these are my adjusted journal entries to kind of demonstrate those. And then from there, we go into our adjusted trial balances. This really helps to be able to see everything that we need to be able to prepare our financial statements. So this is just basically a summary of everything we've done from the journal ledgers or the general journals into our ledgers. It just summarizes everything very neatly and in an organized fashion. And then you have to make sure your balances match at the bottom. And then from here, we take some of this information, specifically the revenue of $44,974, which if there was other revenue that a company produced, we would also bring that over. And then our expenses. So all of these expenses go into the income statement. The purpose of the income statement is to show whether or not there is a net income, which means the company made money, or if there's a net loss, which means they lost money. So that's basically if the revenue is higher than the expenses, the company made a profit. If it's lower than the expenses, the company lost and isn't doing as well. So a lot of businesses will take this as a great way to show whether or not the company is doing well. From there, that net income goes into a statement of retained earnings. So this is kind of the bridge between the income statement and the balance sheet, because you need the retained earnings here at the end. That goes into the balance sheet. This just kind of shows you, it's used by investors and creditors to show financial stability, to see if there is retained earnings and the dividends. And then from here, we move on to the balance sheet. This is basically a summary of the company's assets, their liabilities, and their equities. It allows stakeholders to be able to see a snapshot of the financial stability of the company. Here we take the retained earnings. It goes down here in the bottom. That's why it's an important part between the two things. And then in this, it's important to make sure that your total assets are equaling your total liabilities plus equity, because most people in accounting know that this accounting statement or the accounting equation is assets equals liabilities plus equity. So it's important to make sure that these two are matching and lining up the way that they're supposed to. From here, we go ahead and close our temporary accounts. So basically, closing entries are to reset temporary accounts back to zero so that those balances are transferred to permanent accounts for a new accounting cycle. So in this instance, computer services revenue, that is a temporary account. Revenue is a temporary account. So we move that into the income summary, which is a permanent account. And then from here, we credit off all of these expenses into the income summary as well, kind of just getting everything cleared up so that the next time there's a cycle, it's a lot easier to manage. And then after that, we go back into our general ledgers. Just make sure that all of our accounts are where they're supposed to be. It's important to make sure that our temporary accounts, such as our dividends, are zeroed out, and our revenue, and then all of our expenses. Those are all temporary accounts that always should be zeroed out at the end of a cycle. And then from there, we go into the post-closing trial balance. This is really to demonstrate that all of the temporary accounts are closed, and then that the debits and credits are equal. They should always be equal. So here we have $90,872 debits and $90,872 in credits. So this just demonstrates that all of our debits and credits are equal. And then also you can see that there is no temporary accounts, such as, the revenue unearned. Computer revenue is actually a liability at this time because we have not actually made the money. Once it becomes actual revenue, that will be considered a temporary account, but at the moment it is a liability. And yeah, that's the gist of it. Thank you.